Alright guys, so let's talk about Japan, the dollar, and how there's enormous pressure facing the reserve currency. Now there are many events today that threatens to send it even lower. And because US bonds are the world's reserve asset, the dollar unwinding is a big problem. Now falling dollar threatens to nuke the Treasury market as well. The connection between the two can't be decoupled at this point. Now firstly, Bessent and Trump clearly wants to send the dollar lower to save their industries. And the fall we have seen today is still not enough. This is the chart of the trade-weighted dollar and is different from the USD index. Now, since 2008, he has been rising higher and higher despite the recent correction. And this means US goods are still extremely expensive to export to the world. US companies trying to sell their products globally to their major trading partners are still facing a big currency disadvantage. US consumers are still benefiting from imports from US trading partners, and unless this falls much more, Trump's plan to build an export economy is still crippled. It's a big reason why the big beautiful bill is still going to pass. Sure, a big part of it is to bring in companies using tax cuts as the lure. However, it will drive up the deficits, destabilize the bond markets, and make holding US assets even less attractive. And because US assets are obviously denominated in dollars, it hammers the reserve currency down. And Bessent just confirmed this.
You may have heard one big, beautiful bill floating around Congress. This bill is big and beautiful for Main Street America and investors alike. The president's signature tax legislation will prevent an enormous tax hike on Main Street by making the small business deduction permanent. It will also provide tax credits and deductions for research and innovation to stimulate investment in high-tech operations.
I really understand what he just said. More dollars will be pumped into the US economy through debt. There will be no tax hike and the deficit will not be reduced. In fact, it will increase by over $3 trillion over the next 10 years. So US economic policy is actually easing the financial situation. We are not in a tightening environment. Now, Bessent's Treasury Department is fighting Jerome Powell at the Fed, and thanks to the tariffs, the pressure on the dollar is also compounded, and the relationship here is essential to understand. Now, inflation expectations in the US have been rising. We have gone from just under 5% to 7% in a matter of months, and this has profound effects on the strength of the dollar. The bond market also gets impacted. Now, at 7%, consumption in the US will slow down significantly, and this slows down the economy and makes investments unattractive. And when investors see inflation expectations rise, they will also demand a higher yield. So, apart from the fiscal crisis, the tariffs are also helping to push yields even higher. As a result, bond values are going to go down, and the demand for the US currency also falls. So, just within the US itself, domestic events are conspiring to push the currency even lower. But events without are also setting up the US dollar for a bigger potential fall. Now, the US government wants a weaker dollar mostly based on trade and to export more. But global investors are being forced out of US assets because their own positions are unraveling and they recycled too much money into America. Now, take life insurance in Taiwan for example. Major companies are losing a ton of money thanks to the dollar collapsing. Taiwan Life, a major insurance player, is losing a ton of money just based on the currency exchange rate alone. And as these companies foresee the dollar crashing even further, they will sound the alarm bells. Now, Taiwan Life has mentioned about diversifying its investments across different currencies. And this might include the Chinese RMB, the Euro, or maybe even the Japanese Yen as well. And because all indications still point to the US themselves looking to weaken the currency even further. And here's how serious a further dollar devaluation can get for investors outside the US. A 10% gain in the Taiwan dollar against the USD means a foreign exchange loss of 300 million in the local currency, and that's equivalent to at least 10 million US dollars. And thanks to this big crash in the dollar index, foreign investors like insurance companies now face huge paper losses, plus hedging is now more expensive. Buying insurance when there's already a fire won't be cheap. These companies could also be holding $780 billion in foreign assets, the majority of which are in US dollars, so the amount of exposure is extremely significant. And there's always the possibility of the US strong arming economies for a Plaza Accord 2.0. Now, I personally doubt that would work, but countries themselves might just strengthen their own currencies for multiple reasons. Maybe they feel it helps them negotiate down the tariffs. Now, the Taiwanese central bank themselves admitted to allowing the local currency to soar, and the justification is to cool down market expectations. Now, fair enough. But what if this continues or spreads to other central banks around the world? And thanks to Trump's tariffs, many central banks globally they are facing enormous pressures to strengthen their own currency. Imported inflation is rising and trade with the US is going to slow down one way or another. And this brings us to Japan. And if you thought the Taiwan dollar rising was significant, the higher the Japanese yen goes, the bigger the wrecking ball is for the US dollar. Now let's understand how serious inflation is in Japan. We know it's the highest of the entire G7 today, but we are now entering the twilight zone. Prices in Japan are soaring to the moon. The cost of rice is up by over 98% year over year in April, the biggest monthly jump since 1971. And Japanese people love to eat their rice. And if you're in the West, imagine seeing bread and pasta double in price. Meanwhile, energy prices rose by over 9% after gas and power subsidies ended. So households are paying more while industry just got even more uncompetitive. As a result, Japan's consumer prices rose by 3.5%, even higher than the US. And if we throw in the recent Q1 GDP that is negative, Japan is more or less in stagflation. The bias or the plan now is to strengthen the yen, which also means the BOJ cannot keep suppressing yields to keep the currency cheap. It has to go up. And if you're new to the Japan situation, when the Bank of Japan stops buying government bonds, it will send yields higher. There's no question about that anymore. And a big shout out to our sponsor today, Indigo Precious Metals. When it comes to buying gold and silver, I trust Indigo Precious Metals in Singapore. They have made investing in precious metals safe, fast, easy, and simple for both small and large scale buying. I've been stacking gold for over a decade now, and I've learned two things when buying. You want to buy authentic gold bullion, and you want to buy it at the lowest premium possible to stretch your dollars even further. And I'm glad to say I found both of this at Indigo Precious Metals. Indigo Precious Metals is a leading retailer in Singapore. They specialize in physical gold, silver, and platinum. They are my one stop shop when it comes to buying bullion. Their prices are sharp, and they have the best brands on sale, and I can test the gold on the spot. So if you're looking to make your first gold purchase, Indigo Precious Metals is the best place to start. Whether it's 1 ounce or 1 kilo, this is the reputable dealer you are looking for. So take action today. Click on the link below and enjoy a discount on your first purchase with the code SEANFOO. Start your gold stacking journey today. 52% of total government bonds outstanding are held by the BOJ. That's more than every other category of buyer from banks to foreigners put together. For over a decade, the BOJ has been doing yield curve control. They have been aggressively buying bonds to keep interest rates low to boost the Japanese economy. But by trying to do that today is simply impossible. Japan faces a 25% tariff from the US, and trying to paper that over using financial engineering is impossible. The BOJ is now trapped. Even if they buy a ton of bonds, rates might drop, but the yen will collapse, and that would mean higher imported inflation, then all the input costs will soar. Corporate Japan is already warning of a huge financial hit from US tariffs. Companies from Toyota and Honda all the way to Mizuho and Sony, they are reporting big potential impacts from Trump's tariffs. In total, this could amount to $28 billion worth. Costs are already heading up, and trying to absorb all the tariffs is simply impossible. Profit margins are razor thin for many industries. It's why companies like Nippon Steel they are desperate to enter the US market. Japan can't financially engineer themselves out of this mess. The debt to GDP is just too high and inflation is now a clear and present danger. So they are caught. They need two things to happen. Now the first is for Trump to drop the tariffs to save their export economy, at least in the short term. And secondly, rates have to go up to save the yen. And this has big consequences for the US Treasury market. And because this is still the world's biggest bond market, if this blows up, so will the world economy. Now, decoupling is an event that will take years and even decades. Many countries and companies today still borrow in dollars. So if Bessent's borrowing costs fly up, so does the rest of the world. Now, we just got word that Trump has delayed the EU tariffs, the brutal 50% hit, to July the 9th, so the additional reprieve is longer than 30 days. But instead of US bond yields dropping, it flew up by almost 1%. The 10-year yield is higher than 4.55 today. Even trade deals cannot contain the US bond market from imploding. Everyone is afraid of the US fiscal situation, and as we mentioned before, Trump's bill will force Bessent to unleash a tsunami of bonds to the market. Now, there's a domestic supply crisis coming, and the last thing the US bond market needs is additional competition from the world. Now, Bessent needs global capital to flow to treasuries to stabilize the situation, and that's why he's even floating the desperate banking deregulation. He wants big American banks to buy US debt because local buyers can at least ignore the currency risk. Well, there's another game in town, and it's a really big one. Japan has to strengthen the yen, and as a result, the pressure on US bonds isn't over yet. Since 2024, the BOJ has stopped buying Japanese bonds net on net. As a result, the supply has been growing from negative to positive 10 trillion yen. Even the central bank has been selling their own bonds to the open market, and this floods the global markets with even more JGBs and is the central reason why Japanese yields are flying to the moon. And without a doubt, this poses a real threat for US Treasury demand. Investors might not be buying ultra long Japanese bonds, but anything from the 2 to the 10-year bond is still fair game. Since Trump's reciprocal tariffs, the relationship between the yen and US yields have decoupled as well. Now, when US yields rise, normally this would strengthen the dollar and push down the yen. But now the dollar is falling and the yen is rising, despite US bond yields going higher. And according to Deutsche Bank, this is further evidence that foreign participation in US Treasury market is collapsing. Now imagine you're a domestic investor in Japan. If you see your local currency rising as US bond values continue to crash, would you still buy treasuries? And knowing the debt situation in the US, bond yields could continue to stay high or keep rising. The incentives to move back to local Japanese bonds are very, very tempting. And let's not underestimate how big the Japanese consumer is. I mean, the Japanese customer is. Japanese banks, insurance companies, and retail investors are perhaps the biggest foreign buyer of American bonds. And since 2023, they have been buying tens of trillions of yen worth in US paper. So the odds of a big sell off is growing day by day. The exposure is simply incredible. Japanese investors could shift their buying to other Asian bonds, EU bonds, or just take their money back home. Even though JGB rates are rising, at least they have no currency risk themselves. Everything is in yen. The problem isn't really Japan, they have their own crisis to handle. The biggest culprit of US bonds imploding is the United States themselves. They're simply spending too much money. The big beautiful bill is going to send the treasury market to the underworld. And let's really understand how ridiculous the bill is going to be. Now, there are serious doubts about how much growth this will generate. Is the $3 trillion price tag really worth it? According to Penn Wharton's budget model, it's a horrible deal. By 2034, this will increase GDP by only 0.4%, but consider the trade off. You are juicing up GDP by increasing the national debt by 7.2%. Now, the situation gets even worse as the years progress thanks to high interest payments as well. By 2054, GDP would have only risen by 0.7% thanks to the bill, but the debt would have risen by 12.8%. So, does the bill help the US economy grow? Yes, it does, but the trade off would mean a higher debt burden that pushes the US closer and closer towards the default. And this is why bond investors are revolting and why the dollar is tanking. If big players like Japan stop buying and start selling US debt, it's game over. This will make things go from bad to extremely horrible. But as always, let me know what you think. Will Japanese investors continue selling off their US bonds? And will the rest of the world deleverage their holdings as well? Let me know in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.